This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 13, 2026, and this is the New York pre-market. Now, let's get into it. Fear is currently sitting at 14 out of 100. That is an absolute floor of anxiety, especially when the VIX is hovering near 15. We are seeing a market paralyzed by geopolitical shocks and regulatory headlines, even as the broader equity market remains eerily calm. Let's look at where the bleeding is happening and where, surprisingly, some capital is still flowing. Before we dive into the charts, let's look at the schedule. There are no major Federal Reserve speeches or CPI releases on the immediate calendar for today. However, the market is watching two major corporate developments closely. PayPay, which owns 40% of Binance Japan, is seeking up to $1.1 billion in a Nasdaq IPO, and TD Securities is highlighting the NYSE tokenization as an institutional turning point. These aren't just press releases. They represent actual liquidity vectors entering the system.
That PayPay IPO is critical context. It's not just about the cash raised, it's about the channel. 40% of Binance Japan going public via Nasdaq creates a regulated, institutional-grade on-ramp for Japanese capital. But right now, with fear at 14, that liquidity isn't flooding into spot buys yet. It's waiting.
Let's set the scene. The total crypto market cap is $2.27 trillion. 24-hour volume is $46.9 billion. Bitcoin is down 0.9% to $63,684. Ethereum is down 1.4% to $1,890.09. And the broader market? Avalanche is the only bright spot, up 3.8% to $6.53. Everything else is in the red. We have a lot of noise coming in. Let's tackle the headlines that are actually moving needles. First, Cointelegraph reports Iranian crypto outflows spiking 700% after U.S.-Israeli airstrikes. Second, CoinDesk notes that the U.S. Senate housing bill includes a CBDC ban. Third, Cointelegraph reports Bitcoin futures demand has fallen to 2024 lows. How are we reading the damage from these stories? The 700% spike in Iranian outflows is a sentiment bomb. It's creating a wait-and-see paralysis. Traders aren't looking at fundamentals, they're looking at geopolitical risk maps. When capital gets stuck in a conflict zone, it doesn't disappear, it just stops moving. That stagnation feeds directly into the fear index, keeping us pinned at 14. It's not panic selling yet, it's frozen liquidity.
And don't ignore the Senate Housing Bill's CBDC ban. Pulse is talking about geopolitics, but this is domestic regulatory warfare. A ban on central bank digital currencies sounds good for privacy advocates, but it sends a jarring signal to the entire digital asset framework. It tells large institutions that Washington is still figuring out the rules, and they don't want to bet on the outcome. That's why Ethereum and XRP, the proxies for regulatory clarity, are struggling. They carry the baggage of that uncertainty.
The CBDC ban is background noise compared to the futures data. Cointelegraph reported that Bitcoin futures demand has hit 2024 lows. That is the real killer. Retail might be scared of Iran, but institutions are simply gone. They've pulled their leverage. When futures demand collapses, you lose the buy-side support that usually catches the spot dips. That's why we see such thin, fragile price action around 63,000.
So we have frozen retail sentiment, regulatory noise, and missing institutional leverage. Let's break this down symbol by symbol, starting with Bitcoin. Bitcoin is trading at $63,684, down 0.9%. The 24-hour range is tight, high of 63,902, low of 63,267. Grid, give me the technical read. Where is the floor?
It's a compression zone. The price is hugging the lower end of its recent consolidation. What's striking is the volume profile. We have $46 billion in total market volume, but Bitcoin's relative contribution feels light for this level of stress. The lack of expansion suggests the market is holding because sellers are exhausted, not because buyers are aggressive. The key here is Bitcoin dominance, which is sitting at 56.30%. As long as that dominance holds or climbs, Bitcoin is acting as the shelter, not the leader.
But Grid, you're calling it shelter. I'm calling it a vacuum. The futures demand is at 2024 lows. That means there is no leveraged bid catching the price. If a seller hits hard, say, triggered by more news on those Iranian outflows, who absorbs it? Currently, nobody. The order book is thin. The floor isn't supported by institutional limit orders. It's supported by a lack of sellers willing to chase the price lower right now.
Exactly. And that lack of sellers is fragile. With fear at 14, the moment sentiment flips from waiting to running. The drop can be sharp because there's no leverage to cushion it. The 7-day trend of the fear index is rising from 12 to 14. That acceleration tells me the hold phase is ending. People are getting tired of holding through the geopolitical noise.
And remember, SPECTER here, we need to watch the counter-narrative. The CBDC ban in the House bill is being framed negatively, but for Bitcoin specifically, it reinforces the non-sovereign argument. However, the market isn't buying that distinction yet. The price action is indifferent. That indifference is dangerous. It means the market hasn't priced in the political win for Bitcoin yet, but it's certainly punishing anything else associated with government oversight.
So Bitcoin is holding, but it's brittle. Let's move to Ethereum. Ethereum is at $1,890.09, down 1.4%. The 24-hour range is 1,900.96 to 1,872.07. SPECTER, you mentioned the CBDC ban earlier. How is that impacting Ethereum specifically?
Ethereum is taking the brunt of the regulatory confusion penalty. When the Senate inserts a CBDC ban into a housing bill, it creates legal ambiguity for every stablecoin and Layer 2 solution built on Ethereum. Smart contracts rely on clear legal frameworks. If the political wind shifts toward restrictive definitions of digital currency, Ethereum's utility narrative gets squeezed. It's not just a tech play anymore. It's a political liability play. That's why it's underperforming Bitcoin significantly.
From a flow perspective, that makes sense. We saw Bitfinex reviving tokenized bonds targeting crypto-native yield seekers. Money is moving away from speculative Ethereum exposure and into yield-bearing, fixed-income-like instruments. The flow is drying up from Ethereum staking and decentralized finance usage metrics. Capital is seeking safety in bonds, not smart contracts. The TVL, total value locked, in Ethereum-based decentralized finance protocols is likely contracting as users withdraw to preserve capital.
Technically, Ethereum is showing weakness against Bitcoin. The Ethereum/Bitcoin pair is grinding lower. The chart structure on Ethereum is trying to find support, but every small rally is met with selling pressure. The key resistance is right above the current price, around 1,900. Until Ethereum can reclaim that with volume, it's just drifting lower alongside Bitcoin, dragging down the rest of the altcoin market. The dominance rise confirms Ethereum is being shed.
Retail sentiment on Ethereum is particularly sour right now. You look at community forums, and the anger is directed at the price. But the root cause is the regulatory fear. People are afraid of holding an asset that politicians are actively debating in unrelated bills. That guilt by association is suppressing bids. No one wants to catch a falling knife when the knife is named in a Senate hearing. Moving to Solana. Solana is at $76.08, down 0.9%. Range, 75.35 to 76.53. It's tracking close to Bitcoin, but losing ground. What's happening on-chain here?
Solana is suffering from the beta drag. It's a high-speed network, but in risk-off environments, capital leaves the fastest horses first. Core Scientific's Q4 results disappointing highlights operational risks in the mining and infrastructure space, which casts a shadow over all L1s. Plus, with futures demand low, Solana lacks the derivative depth to sustain a rally. It's relying purely on spot inflows, which are currently minimal.
Chart-wise, Solana is testing its lower Bollinger Band support. It hasn't broken it yet, but the wicks are getting longer. That suggests indecision. If it breaks below 75, the next logical stop is deeper. But more importantly, look at the relative strength. Solana is weakening faster than Bitcoin. This is classic alt-season prep failure. Usually you'd see alts pump first. Here they're dumping while Bitcoin holds. That's a bad sign for short-term momentum.
Don't forget the geopolitical angle on Solana. It's a popular chain for smaller, less regulated transactions. When Iran's outflows spike and authorities start chasing those flows, Solana's anonymity features become a target for scrutiny. Regulatory heat on transaction tracing tools increases for chains like Solana more than for Bitcoin. That's a latent risk that keeps large holders cautious.
Now let's look at the outlier. Avalanche. Avalanche is at $6.53, up 3.8%. It is the green candle in a red ocean. Grid, explain this move. Is this real strength or a dead cat bounce?
It looks like a breakout attempt, but I'm skeptical. The volume isn't overwhelming yet. It's decoupling from the sector, yes, but it needs to hold above 650 to confirm any sustainability. The pattern is forming a higher low while everyone else makes lower lows. That's bullish relative performance, but not necessarily absolute strength. It's attracting attention, but is it attracting money?
I think it's structural. TD Securities highlighted NYSE tokenization as an institutional turning point. Avalanche has strong enterprise partnerships in supply chain and gaming. When institutions enter via tokenization, they prefer chains with proven throughput and institutional-grade compliance tools. Avalanche fits that enterprise safe haven narrative better than Ethereum right now, which is tangled in regulation. So, the flow is moving into Avalanche not as a gamble, but as a proxy for institutional adoption.
Sentimentally, this is interesting. While the broader market is in extreme fear, Avalanche has a dedicated community that is largely insulated from the macro fear. They're focused on network upgrades and partnerships. So, when the rest of the market dumps, Avalanche holders aren't panicking, they are accumulating. That conviction is providing a bid that others lack.
Be careful. The institutional narrative is great, but Avalanche is still an altcoin. If the CBDC ban expands or if regulatory scrutiny widens to include all smart contract platforms, Avalanche is in the blast radius. Its separation from the market is a bubble waiting to pop if the broader regulatory environment turns hostile. It's a trade, not a safe haven.
Let's touch on the laggards quickly. ICP and FIL are both down 3.7%. XRP is down 1.6%. Why are these failing?
XRP is the poster child for regulatory overreach. Every headline about crypto regulation hurts XRP disproportionately because its entire valuation is tied to the hope of legal clarity. When the Senate discusses bans, XRP holders feel threatened. It's a sentiment crush.
ICP and FIL are legacy storage projects. In a flight to quality scenario, investors dump old tech to buy Bitcoin or yield-bearing assets. There's no fresh narrative driving them. Core Scientific's disappointment reminds everyone that even physical infrastructure is risky. Digital infrastructure without a clear revenue model is even riskier.
Finally, let's look at the broader picture. Apex, tie this together, we have a market cap of $2.27 trillion. Fear is at 14. Futures demand is at lows. Yet Avalanche is up 3.8% and PayPay is doing an IPO. What is the structure telling us?
The structure is telling us that we are in a structural transition phase, not a crash. The fear is driven by idiosyncratic sharks, Iranian outflows and Senate bills, not a loss of faith in crypto itself. Grid noted that Bitcoin dominance is rising to 56.30%. That is the key. Capital is fleeing to the only asset with no regulatory counterparty risk, Bitcoin. Meanwhile, alpha is emerging in specific sectors like Avalanche, which are aligned with institutional adoption narratives, tokenization. The rest, Ethereum, XRP, legacy alts, are being punished for regulatory uncertainty. The market isn't dead, it's repricing risk. We are seeing a bifurcation, safe haven Bitcoin and institutional narrative Avalanche/tokenization versus regulatory liability Ethereum/XRP. The PayPay IPO is the spark for the latter, but it requires time to diffuse. Right now, the fear is dampening that diffusion. Wait for the VIX to rise or fall in sync with fear before concluding the direction. Until then, the market is consolidating, not reversing.
So, the takeaway for today is clear. Bitcoin is holding firm as the ultimate shelter, but it's fragile without futures support. Ethereum and XRP are vulnerable to political headlines. Avalanche is showing early signs of institutional alignment, while the broader altcoin market is suffering from a lack of leverage and rising fear. We watch the PayPay IPO for liquidity queues and the Senate bill for regulatory risks. No major economic events are on deck, so the market will likely continue to digest this news flow. Stay disciplined, manage your risk, and keep an eye on that dominant split. This is ShadowQuant Crypto Edition. Thanks for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.